From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for April 25th, 2025. Let's check the calendar. The Brew Crew is in St. Louis this weekend, and they moved to Chicago for 3 games with the White Sox. The Bucks need a win tonight at home. They're down 2-0 to the Pacers. The Milwaukee Film Festival continues this weekend at the Oriental Theater. And after the movie, you can get a flight of 4 chocolate espresso martinis at Indulgence Chocolatiers on South 2nd Street. You might want to share those 4 drinks with a couple of friends. Just looking out for you. Let's start with being polite is not a bad thing. But an AI tech billionaire complains that people are saying please and thank you to his OpenAI chatbot. He continues his rant saying please and thank yous are costing millions in electricity. Hey, Sparky, you're a multimillionaire. Shut up. This is funny because it didn't happen to us. A North Carolina woman glued her eyelids shut. She mistook her nail glue for eye drops. Doctor said she should completely recover in about 6 weeks, but I'll bet she never does that again. And finally, from Michigan, a 19-year-old boy took some drastic measures when his girlfriend went on a cruise with her family. She left him behind to babysit her pets. Well, he wasn't very happy about that, so he called in a bomb threat to the Carnival cruise ship. The ship has more than 1,000 rooms and was headed for Jamaica before it was redirected. Well, they were literally a boatload of unhappy people, and the dude is now doing 8 to 12 months. It would be rather poetic if his jail cell had an ocean view. On the podcast today, we have Dave Sandstrom, Kendall Bauer, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thank you, Max. A wonderful week it was. A little easier to put some smiles on faces. The NASDAQ up 6.7% this week. That's 1,096 points, closing today at 17,383. The S&P 500 up 4.6%, 243 points this week, closing at the bell on Friday at 55.25. And the Dow Jones Industrial Average, a little pokey, but still up 2.5. That's 971 points after adding 20 on Friday. Again, up 2.5% for the week. For the year, NASDAQ still down 9.9%, the S&P down 5.9%, and the Dow Jones Industrial Average down 5.5%. You know, Dave, a week in which we've seen, it feels like a bit of a reprieve from some of the pain that was this tariff conversation. I think there's a danger right now in assuming that everything is fine. What are you kind of seeing? What are you kind of talking to clients about as we kind of now are navigating a world in which we're more or less in a wait-and-see place?
Well, Kyle, I think it really speaks to the real singular focus that investors have had, and that's obviously on tariffs. If you go back, you can go right back down to the original announcement date of the tariffs. That was a very, very large drop, the preceding or the subsequent 2 days. And then, of course, once we got a little bit of a reprieve with a delay, markets went through the roof. So it has definitely been tied to anything to do with tariffs. So we're getting a little reprieve right now, but as you pointed out, the potential for that to go right back the other way should that tariff conversation turn largely negative. I think what's valuable for clients and investors right now is the fact that got a bit of a reprieve this week, built back quite a big number here in growth stocks and in the S&P as well. So if you woke up at the beginning of this week thinking, oh my gosh, I really blew it because I did not really understand my risk tolerance and I was overextended, well, maybe now's a chance to revisit that because you got an opportunity to do so without having to lock in as big of losses. So might be an opportunity to revisit that if you've been largely uncomfortable lately with what's going on. And but I don't certainly take this as a time to hit the gas and go all in.
And Kendall, maybe that's some of the conversation that we should be thinking about right now is that There is this thought that, well, things look a little better. So, hey, let's reassess. What do we know that's new right now? And I think the reality is that we have not seen a lot of new fundamental information. There's not really an understanding of what the other side of this looks like. And in many ways, at least to me, it feels very much like, not that I've been there, but standing in the eye of the hurricane, where we just came through this period of incredible volatility, stocks, bonds, really any asset class that kind of got whipsawed over the last 2 weeks. And we're staring down the face of now the other side of this storm, where at some point in time we have to get to some consensus on what trade negotiations look like and how we get out of the mess that we've created. I think there is this tendency then to go, well, what should we do different? And maybe to Dave's point, and I wonder if you've got anything to add there, I think it's less about what we think is going to happen next and more about, at least for now, how did we respond to what already happened?
Yeah, I think you got to be cognizant and be careful of something we call in the industry a dead cat bounce. We saw a few of these in 2022, not comparing this exact market to that, but it's that idea of you have a big drop, whether it's a correction or a bear market, and then you get these reprives throughout, only to see the markets, drop further after the fact. So, as Bob once told me, don't rush to catch a falling knife. But I do think, as Dave pointed out, if you got nervous or you felt like maybe your stock bond allocation was a little stock heavy, coming into all the tariff announcements, you've gotten a nice bounce back, and maybe it is a good time to reassess and talk to your advisor about whether or not your portfolio's allocated to where you're comfortable.
And despite all the volatility from the start of April, now with just a few days left, the S&P is not down nearly as much as maybe what it feels like in many cases. I think the challenge, of course, is, assuming that means it can't go down more, but also, I think I am fairly encouraged by the fact that we've navigated this uncertainty so far without the pain that we've seen in other periods of that kind of uncertainty. And I think one of the things that saved us has been our bond funds, that the role that balance has played was pretty significantly emphasized in this latest stretch. Yeah, we had a period of even bonds taking a pretty big dive. We had a week where bonds saw the biggest move they've seen in a very long time, and yet they've, even now bonds seem to have stabilized.
Kyle, I think it's just a fantastic reminder of the fact that the bonds play that important role in the portfolio. And I know that, we always suffer from recency bias, and we go back to 2022 and that relationship really broke down on investors, and I think it spooked a lot of people because bonds obviously had a very difficult time. But you have to remember the circumstances there. We were at a situation where interest rates were near zero, and we had a large increase by the Fed to fight inflation. We're at a situation now where interest rates are elevated, 10-year Treasury somewhere between 4 and 4.5%. So we have a little bit of a cushion now. We always used to talk about how the coupon on your bond and bond funds was that shock absorber that could help you ride out price volatility because you're getting paid those interest payments. So we're back to that now. When rates were at zero, boy, you felt every bit of that price movement. And now, even though prices have been volatile, we're starting to collect that interest for the year. I think that provides some stability.
I think to go back, Kyle, to what you just mentioned about bond performance year to date, it's been interesting. I've had a handful of meetings this week where clients, dragged in from that headline a few weeks ago of the biggest movement in the bond market, were convinced or thought that their bonds were somehow still negative on the year. So I think just a good reminder, I would say, this year we've been living in a market largely being driven by headlines day to day, sometimes intraday. I mean, we've seen that happen this week where you have news come out in the morning that shifts markets, and then you get a comment from someone in the administration saying opposite and it shifts, and then the president tweets later in the day. So just be cognizant of headlines driving market movement day to day, and try not to get swept up into the big ticket headline.
One other thing I'd throw out there, Kyle, just as a kind of a specific instance, is I would like to just point out the kind of unusual movement in municipal bonds that we've seen recently. Important to understand that those yields right now, I think, are attractively high, especially if you are in some of the upper income brackets right now. And there was a pretty significant downward price pressure on municipals recently. I wouldn't take that as a sign to panic. Matter of fact, I would definitely encourage you to maybe look at a hold position on that and not run from the muni market right now. I think that that's offering some compelling yields, especially, like I said, if you were in some of the higher tax brackets.
You bring up an important point, which is that we often talk about bonds as if it's, an asset class just like buying different parts of the stock market. But the bond market is, in many ways, bigger and more diverse than any of the kind of elements of the stock market that we look at. And so sometimes it becomes really important to differentiate, as you're rightfully doing, between taxable bonds and municipal bonds, or between treasuries and agency debt and corporate debt. And we're in a market in which sometimes that nuance can be even more important. One of the other areas that we spent a lot of time looking at in prior periods of market stress was things like, how much are you being compensated to take risk with your bond portfolio? And that's an area where we started to see some spreads, what you have to be paid in order to take that risk, widen. And then all of a sudden, as things calmed down, they came back down a little bit. And so, I think you're rightfully pointing out, Dave, that the muni market has some unique opportunities right now. It had held up better in the last kind of bout of volatility the bond market saw in 2022. The rally out of that pain was a little bit better for munis. As a result, I think it hasn't been quite as rewarding so far this year as maybe some of those taxable bond areas, but especially for investors in higher brackets, there's definitely some opportunity there.
And maybe this is a little speculation on my part, but how much of that downward pressure on the muni market was driven by big money selling municipal bonds prior to some of the tariff announcements, given that they did hold up well, having money on the sideline for whatever? Maybe it was to redeploy and buy the dip, quote unquote. But, to your point, I'm certainly not driven away by them just because of recent downward pressure.
Yeah, kind of when we look at especially short-term movements in those various asset categories, a lot of it is flow-driven. It's money in, money out. And what we know tends to happen in periods of volatility is that investors sell the thing they think they can get the best price for. And that can mean that if you're a little later to the game short term, well, you're not getting the same price you thought you should. And so I think there is some element of, we sold munis because we thought we could get a better price for them than selling those growth stocks that were down 15 or 20%. But again, I think that tells us nothing about the longer term outlook. And the longer-term outlook for fixed income is that rates are a lot higher than they were. And especially in the muni market, for those in higher tax brackets, there's still some good opportunity there. Joel, a couple of, I think, meaningful economic indicators this week. The problem, of course, is that so much of what we're looking at is backward-looking. We can get there, but I think maybe one of the most important pieces was consumer sentiment this week. And the reason why we like to look at it so much closer than maybe some of the other pieces is because it does tell us a little bit more about where we think we're headed.
Yeah, it does. It has a lot of digs against it, but it's one of the more contemporary numbers that we look at. The University of Michigan, for the sentiment survey, just finished interviewing consumers, and so their data is pretty fresh. And so their report for the month of April is actually kind of dismal. It's down 8% from where it was in March. It's been down 4 months in a row. It's just looking at expectations that consumers have. Those are down 32% in the last 3 months. That's the biggest dip that they've had in a 3-month period since 1990, when we had a recession. So those things don't look that great. People are asked in these surveys, what are your expectations for inflation a year from now? And the consensus was 6.5%. That's the highest number that they've gotten from that since 1981, when the actual inflation rate was got up to 11%. So some of the digs against that is that, consumer sentiment is a rather fickle thing. A lot of times we find people saying that, they don't feel real good about their personal finances or the job market or about the economy, and then they keep on spending money. So they say one thing, they do another. That happens sometimes. there are some underlying things that, especially in the job market, where, as opposed to more recent polls, they're not having as much confidence in the job market, and a lot of it gets to that uncertainty about the trade policies. And if anything, I sort of saw the sentiment numbers underscoring recent downgrades in the U.S. economic forecast, where we had the Fed last month, downgrading its expectation for economic growth this year. Earlier this week, we had the Conference Board Business Group downgrading its GDP forecast for 1.6% this year. 2 months ago, it said 2.5%. The International Monetary Fund this week, they said that the U.S. will be 1.8%, around the same growth rate, but their prior forecast in January was 2.7%. So, we know that consumers drive the economy. That's why a lot of economists are interested in the sentiment number as sort of a forward indicator of what might happen, but we don't know. It's a softer number.
A lot of those forecasts are very macro, top-down, hey, here's what we see, big picture. What's interesting to me is how many of the kind of bottom-up looks have started to show some of that similar weakness. And, one of the things I tend to look at is, what are CEOs saying about their business? What are they predicting for path forward? And you look at some of the tourism businesses, some of the travel companies like American, Southwest, basically pulling guidance on their earnings for the year because they're seeing the issues with consumers. They're seeing the issues with, maybe they aren't going to spend on travel the way that we thought they were going to this year because they don't feel as good about the economy.
And we had PepsiCo, Chipotle, Procter & Gamble downgrading their forecasts because they say that consumers aren't going to be buying as much snack food because they're feeling more anxious about the economy.
I'm fond of saying that the plural of anecdote is not data, but in this case, I think we have enough anecdotes to start to say, okay, it's showing in the data, right? That when we look at earnings forecasts, it's a lot harder to get confidence in whatever that target is looking ahead because the very people that are being interviewed to put those forecasts together are saying, hey, don't trust us right now. Don't trust these numbers because there's really not a way for us to be certain.
If nothing else, the trend's in the wrong direction.
The trend is absolutely in the wrong direction. And again, I don't want to paint too dark a picture because what we're talking about right now is an environment clouded by a conversation that is going to have to be resolved at some point in time. And once you start to see some of that resolution, I think it becomes at least a little easier to say, here's where earnings are headed. And more importantly, as investors, we're not counting on what do the next 12 months look like. Yeah, we talk about that because that tends to be the easier number to try to pinpoint, but we're very much looking at where is this headed over the next 5 years, the next 10 years. And so there is kind of these competing, I think, conversations right now of, hey, things are a little cloudy right now, but then we got to go back to, okay, what does it mean for our ability longer term as investors to see the companies we invest in be profitable?
Kyle, it's often said that, financial forecasting is more art than science. But I can't think of a more difficult time to forecast than currently when you put the tariff conversation on the table because, it's obviously something that corporations can't ignore for the future. But the picture is completely different if a year from now tariffs are at elevated levels and in full force versus if they're not. Those are pretty stark contrasts. So very difficult to forecast out right now. Same thing with the forecasting of the consumer sentiment numbers, Joel. It's like if people are really concerned about that, about the fact that they're going to be here, tariffs that is, different picture than if they're not. So it's a very, very tough time to be a forecaster.
And Joel, that uncertainty shows up in the survey for leading economic indicators. Another one of the few forward-looking indicators we have. Imperfect as they all are, but, painting signs of that uncertainty.
Yeah, that one, what I like about that measure is that they take a 6-month look. So it's not just 1 month, but they take a 6-month, and the 6-month look at the economic indicators showed that the economy is slowing down or their index is slowing down less than it was 6 months before, but it's still slowing down. And that survey of those indicators, that was done before April 2nd, before the trade announcements were made.
And then some backward-looking stuff that we should touch on just to kind of catch up on where we are, especially in the housing market, both new home sales and existing home sales this week.
Yeah, new home sales is a fraction of the market, but it's important because that's where we're going to be getting our inventory, which is so needed for the larger existing home sales. And new home sales picked up in March. The other one, though, the big existing home sales number is looking worse. It just sank another 6% in March from February. Remember that we ended the year in 2024 at the lowest home sales rate in 30 years. So that's looking a little more dismal. The National Association of Realtors is citing affordability challenges, saying that houses are really expensive right now, but also the elevation of mortgage rates relatively is setting people back. And for the first time, the median price of an existing home sold in this country was above $400,000. So that's something to sneeze at.
A little more expensive, yeah. So I think on the heels of a week in which we can be pretty happy with the performance of our stocks, especially bonds continue to do what we expect them to do. Just a reminder that there's still plenty out there that we need to work through, that it's showing up in some of the economic indicators, it's showing up in other areas I think that we have to pay attention to. And so this is not the time to just assume that all the problems have been solved and the market can only go up from here. But I think a good reminder that even in periods of uncertainty, we can have some good stretches. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.